It's very nice to be at Williams. An interesting historical fact is that when I was coming out of graduate school in 1969, this was the first place I interviewed for a job, but I didn't come here. I went back to Canada, where I come from.
You want to speak close to
okay.
the
So as I was saying, it's nice to be here, and an interesting historical fact is that when I first came out in the job market in 1969, this was the first place I interviewed, and I didn't come. I ended up going back to a university in Canada, but I always wondered what it would have been like if I had been here, and it's nice to be back. So I'm going to talk about the IMF and the Eurozone, and I'm not going to tell the whole story of the international lender of last resort. I'm going to focus primarily on some of the problems that worry me about the current crisis. So the IMF was established at Bretton Woods in 1944 as part of the par value system, and its main function was to act as an international credit union for its primarily advanced country members, and then provide temporary loans to its members to finance current account deficit. It also acted as umpire for the par value system, and after the collapse of the Bretton Woods system in 1973, the IMF changed its mission to one of helping emerging countries and less developed countries deal with payments imbalances, then recycle petrodollars in the 1970s, help resolve the Latin American debt crisis in the 80s, help reintegrate the countries of the former Soviet Union into the global financial system in the early 90s, and then become an international lender of last resort during the crises of the 1990s. And today it's heavily involved in rescuing the peripheral members of the Eurozone from their sovereign debt crisis. And the Eurozone is quite a different entity than the emerging markets. Unlike these countries, it's not a sovereign state. It's a monetary union, but not a fiscal union. There is no common fiscal authority or bank regulator or deposit insurance fund. And I argue that the IMF faces a potential problem of credit risk if one of the members of the Eurozone were to default on its obligations and reactivate its old currency. Now, the IMF has dealt with, for a very long time, and people in this room that have been there know about it, have dealt with dysfunctional fiscal federal states. And it's always dealt with a central government and not the states or the provinces. And I'm going to argue that until the Eurozone moves more in the direction of a fiscal federal state, there are some other changes that occur, the fund is exposed to significant losses, and that means the member states and the chief principal shareholder is exposed. So I'm going to talk for a while about Argentina and Brazil, compare it to the Eurozone, and then just at the end consider the risks the fund faces and discussions of possible reforms. So Argentina is a fiscal federal state. It was founded in the early 19th century as a federal republic, and it was founded on many of the same principles as the U.S. It took a long time before the federal state got to work, and it developed. It took almost 60 years for that to happen. And even in its earlier years, it adopted the kind of a fiscal package that the U.S. did with Alexander Hamilton in 1790. They took on the whole package, but it didn't exactly work. And its fiscal history was characterized by a pattern of excessive government debts, often accompanied by high inflation and ending with defaults. And during the 1980s, both levels of government, the subnational and the national, borrowed extensively. The provinces accounted for roughly 40% of the public sector's deficit. And these deficits were financed by discretionary transfers and loans from the federal government. And the provinces borrowed from their provincial banks, who then discounted the debt at the central bank, effectively giving the provinces a share of the inflation tax revenue. So by the end of the 80s, this led to a hyperinflation. And then between 92 and 94, the federal government financed special rescue operations for 7 provinces. So the convertibility law that came in 1999 created a currency board which pegged the peso to the dollar, and that was supposed to end central bank financing of public sector deficits at all levels, but it didn't work. The federal government was unable to control provincial spending. Provincial debts expanded through the 1990s, and they were ultimately absorbed by the federal government. And the process ended, and there's a lot of pieces of the story that I don't have time to tell you, ended with a national default and exits from the currency board in 2002. And Michael Musa, who died last year and used to be at the fund, I mean, he had a brilliant book that sort of tells you this whole story. And in fact, IMF conditionality in a series of rescue packages was unable to get Argentina to deal effectively still with its fiscal federal problems. So now Brazil also has a complex federation. There are 3 government levels, and they have a union of 26 states plus the federal district and more than 500 municipalities. And the story for Brazil was a lot like Argentina. There were 3 major state-led debt crises between the 1980s and 2000. And the mechanism of the states getting into trouble running big fiscal deficits and then getting bailed out by the center, the same mechanism came about. And so in each case, the high levels of state expenditure led to these crises. And the last crisis in 1999 led to a fiscal responsibility law in 2000, which greatly increased federal government controls over subnational borrowing. And the IMF was involved in rescue packages throughout this period, and they always urged Brazil to reform its fiscal federal arrangement. That was part of the conditionality, and actually, eventually it was successful. So they have been out of trouble now for over 10 years. Now, the point about this is that in each case, the flawed fiscal federal system allowed the member countries to run up large fiscal deficits knowing they'd be bailed out by the federal government. So we're getting to the bailout story again. And these bailouts led to sovereign debt crises and currency crises, which led them in turn to go to the IMF for funding. And in the case of the IMF, of Argentina in 2001, the IMF eventually pulled out when it became clear that the promised fiscal strategies and reform wouldn't succeed. And that helped precipitate the crisis. And as I said, true fiscal reform is yet to occur. But in the Brazil case, they actually did avoid a debt crisis in '99, and they did reform their fiscal federal system. And in both cases, the fund dealt solely with the federal government and not the individual states. And ultimately, the central government was, okay, that's good. The central government was responsible for servicing the debt and repaying the borrowings from the fund and enacting the conditions of its program. So what are the lessons? I'm going to talk about the lessons for the Eurozone and then for the IMF. So lessons from these experiences should be heeded before the IMF gets, I mean, it's already too late, but gets too heavily involved in the Eurozone. The loans to Greece, Portugal, and Ireland, they're large, but I suspect the credit risk is manageable. Greece is in a precarious fiscal state, and the arithmetic of its debt suggests that a major default is likely at some point in the future. Now, were Greece really to default on its debt and leave the Eurozone, then the cost of repaying the IMF in devalued drachmas, paying the loans that were contracted in euros, is going to increase the likelihood, I don't know how great that is, that they would default on its debt to the IMF. Now, that doesn't happen very often. That's a very bad thing to do. It's only happened, I think, a couple of times, and these were very poor countries. And it probably wouldn't happen because the rest of Europe would probably bail out Greece again. But ultimately, it could happen. And the IMF, in that case, the IMF could absorb the loss. But what about larger countries like Spain or even Italy? The Maastricht Treaty does not allow bailouts, but de facto they do occur. The new European stability mechanism has significant loss-absorbing capacity to protect it from default of one large euro area zone country. But is that enough to protect the fund from credit risk? So ultimately, the Eurozone, or the EU, I mean, that's another issue, like the federal governments of Argentina and Brazil, they should be held responsible. Okay. And a way to do this, of course, is for the Eurozone members to give up their seats at the IMF and be represented by one seat for the Eurozone as a whole. And this has been a contentious issue, and maybe they'll move in that direction. But if they don't do something like that, then the IMF is exposed to greater credit risk than ever before in its history, which means that the taxpayers of the member states, and especially the principal shareholder of the United States, will be required to make up the loss. Now, a lesson for the IMF, again, this is a controversial issue. One possible lesson for the IMF is in the future to change the practice of always appointing the MD from Europe. I think that if it did that, as many people would say, it would make it more competitive and allow the emerging countries to have a chance at the position, but it would also remove the possible conflict of interest between the MD and rescuing the Eurozone from its ongoing crisis, because there is this conflict there. I mean, of course, they don't say it is, and they'll always deny it, but the fact that the last two MDs have been from France and the previous one was from Spain, I mean, they have an interest. They have an interest in preserving the euro. And then there's also another interest, which is, at least in the previous MD, that there was a political issue for him in going back to France. It was unfortunately interrupted by other problems. Okay, so I'll stop there. Thank you. Yeah.